Welcome, everyone. We're doing another deep dive today, taking apart a really important earnings call to pull out the key bits you need to know.
Yeah, today it's Fluor, the big global engineering and construction player. We're looking at their Q3 2025 results, which they announced pre-market November 7th.
And the mission, I guess, is to figure out how a quarter with this massive headline-grabbing loss actually got a pretty positive reaction from the market.
Exactly. It looked like a disaster on paper, that GAAP number, but peel it back, and it's a different picture. It was really a masterclass in managing some messy accounting. Okay,
let's get into it then. That GAAP number, a loss of $4.30 per share. That sounds, frankly, terrifying.
It does, and if that's all you saw, you'd think things were falling apart.
But the stock went up, so clearly the market just shrugged that off.
Pretty much ignored it, yeah.
Yeah.
The focus shifted immediately to the operational side and what they're guiding for the future. With these complex ENC firms, you often have to look past that main GAAP number.
Right, you look at the adjusted number, the non-GAAP EPS.
Yeah.
And that strips out, it strips out the big one-off hits, doesn't it? Like this huge litigation charge we'll get to.
Precisely. And that adjusted EPS came in at $0.68. The market was expecting something like $0.44.
Wow. Okay. So a really significant beat on the operations side.
A very strong beat, especially when people were looking for confidence that management, has its hands on the wheel.
Okay, but we do need to talk about the messy part, that GAAP noise. It wasn't just the earnings per share. It hit revenue too, right?
Oh, absolutely. Reported revenue was $3.4 billion. Consensus was near $4.2 billion.
That's a huge miss, like nearly 20%.
It looks like a massive miss. But, and this is the key thing, it wasn't because projects dried up or anything like that. It was almost entirely down to a $653 million revenue reversal.
A reversal?
Yeah.
So taking back revenue they'd previously booked.
Exactly. It's tied to that Santos LNG project litigation ruling. They had to reverse that revenue because of the adverse ruling. It's an accounting requirement.
Ah, okay. So once you kind of mentally set aside that $653 million, the underlying business looked healthier.
Much healthier. You separate out that big liability cleanup, and the actual project execution looks pretty solid.
And it's not just about cleaning up the past mess. Management sounded pretty confident about the future, too, didn't they? They raised guidance.
They did, which is a strong signal, right? You take this huge accounting hit, but then you immediately say, actually, the rest of the year and beyond looks better than we thought.
So what are the new numbers?
They bumped up the full year 2025 adjusted EPS guide. It was on $95 to $2.15. Now it's $2.10 to $2.25.
Okay.
And adjusted EBITDA guidance also got a lift. Now $510 million to $540 million. The market really liked seeing that separation. The idea that the litigation mess was contained, a one-off, and the core engine is actually running stronger.
Right. So moving beyond just the numbers, the strategy, the CEO talked a lot about disciplined project delivery. Sounds like a shift away from past mistakes.
Definitely. It feels like, as you said, a kind of corporate detox. Two big things stand out strategically. First, dealing with that Santos issue once and for all.
The $653 million charge.
Yeah. That whole amount hit the Energy Solutions segment in Q3, which is why that segment reported a huge loss, $533 million for the quarter.
But the key is that project was finished ages ago, right?
Yeah.
This is just the accounting catch-up from the court ruling.
Correct. Management was very clear. This is it. The hit is taken. It's done. We move on. Short-term pain on the P&L to clear the decks.
Okay, so that's cleanup phase one. What's phase two of this detox? Getting leaner.
Exactly. Shedding non-core assets. And the big one there is NuScale, their stake in the small modular reactor company.
They've held that for a long time.
They have. But the strategy now is clear. Become an asset-light E&C services firm, not an investment company holding on to these side bets. So they laid out the plan to sell off the remaining NuScale stake.
And they gave a timeline.
They announced the conversion of their holdings to Class A shares, which are easier to sell, and the target is to be fully exited, completely sold out by the end of Q2 2026.
Okay, so less than 2 years. That unlocks a lot of cash.
A significant amount of non-core capital. And that brings us straight to the balance sheet and capital return.
Because the cash flow looked pretty good too today. Operating cash flow was what, $286 million?
Strong operating cash flow. And that strength, plus the plan for the NuScale cash, allowed them to announce something pretty aggressive on the capital return front.
The buybacks.
The buybacks. They authorized plans to target another $800 million in share repurchases.
Another $800 million. on top of what they were already doing.
Yeah, that brings the total target to $1.3 billion over just a 15-month period through the end of next February.
That is a serious commitment, especially right after taking that big Santos charge. Addresses liquidity concerns head on.
Absolutely. And critically, they explicitly said the money from selling NuScale is going towards these buybacks and future returns.
Oh, so they're not using the NuScale proceeds to pay for the Santos settlement.
No. They were very clear. The Santos payment will be covered by existing cash and insurance proceeds they expect to receive. That separation is huge. It signals the core business is throwing off enough cash to handle the litigation fallout, while the asset sale directly funds shareholder returns. Big vote of confidence.
Okay. Confidence in the finances.
Yeah.
What about confidence in the future work? The backlog. You mentioned disciplined delivery. That ties into the type of work they're taking on too, doesn't it?
It's arguably the biggest strategic shift. It's not just about the size of the backlog anymore. It's about the risk profile.
Lower risk work.
Much lower risk. So new awards in Q3 were $3.3 billion. Impressive number. But the really impressive part, 99% of those new awards were reimbursable contracts.
99%. Wow.
And the total backlog, which stands at $28.2 billion, is now 82% reimbursable.
Okay, but maybe just quickly explain for listeners, why is reimbursable such a big deal compared to the old way?
Think of it like this. Old-style lump sum fixed price contracts were like Fluor saying, we'll build this massive complex plant for exactly X dollars. If steel prices tripled or there were huge delays, Fluor often had to eat those costs. That's what caused those massive write-downs a few years back.
Right, huge risk for Fluor.
Huge risk. A reimbursable contract, though, is different. It's more like cost plus. The client agrees to cover the actual costs Fluor incurs, plus pay them a fee or margin on top.
So Fluor gets paid for the work done, and the risk of costs spiraling sits mainly with the client.
Exactly. When your backlog gets to 82% reimbursable, you fundamentally de-risk the business. Commodity price spikes, labor shortages, unexpected site conditions. Most of that financial risk is now borne by the client, not Fluor. It's a complete transformation from the fixed price gamble.
That definitely makes future earnings seem more predictable, more stable. Okay, so outside of the energy solution segment, which obviously had that big loss due to Santos, where did they see strength?
Urban Solutions looked solid, profit of $61 million there. That's driven by mining and metals, ramping up copper's big critical minerals, and also life sciences projects. That seems like a reliable engine.
And mission solutions, government work.
Also performed well, $34 million in profit. They highlighted a new big contract win too, $1.1 billion, 6-year deal with the Department of Energy, work at the Portsmouth site in Ohio, so good momentum there.
Okay, so the current business looks de-risked. Financials are getting cleaned up. But what about the future pipeline? All this talk of discipline is good, but you need growth too. I heard something about a delay.
Yeah, the pipeline itself looks strong, but the timing of when that work converts into actual revenue and profit, well, that's shifted out a bit.
How much of a shift?
Management talked about external factors, things like trade uncertainty, policy changes, clients taking longer to give the final go-ahead on big projects. FID delays. They said these have caused roughly a 4-quarter shift in when they expect the associated EBITDA to hit.
A full year delay. So that big $90 billion new awards target they had for the cycle ending 2028.
That target is still technically in sight, they say. But the reality is the bulk of that revenue and profit is now weighted more heavily towards the back end of that cycle, so 2026 to 2028, less in the immediate future.
Is that delay, is it genuine macro stuff, or is it maybe a bit of managing expectations lower after a messy quarter, pushing the good news out a year?
Probably a bit of both, right? There are definitely real headwinds out there for big capital projects. But yeah, it also serves to set a clear expectation for 2026.
And what are they saying about 2026 now?
The initial guidance or sort of signal is that 2026 EBITDA should be marginally better than the newly raised 2025 guide.
Marginally better. Okay.
And the drivers for that growth are expected to be continued strength in urban solutions. Again, copper and mining are key there. And also, importantly, the resumption of work down in their Mexican joint venture. That JV actually provided some good news on cash collection recently, too. Oh. Yeah, they collected $800 million from that JV in Q3, and then another $300 million just in October. So that helps the cash flow story significantly.
Okay, so if the really big stuff is pushed out a bit, are they trying to accelerate work in other areas to fill the gap in the shorter term?
They are. They specifically highlighted areas where they're putting more resources because client demand is like right now and urgent.
That's sad.
Power generation is a big one, both gas-fired plants and also supporting nuclear, potentially SMRs down the line. Then there's complex data centers for the hyperscalers. That's a massive build-out happening globally.
Huge demand there.
Absolutely. And also critical minerals, again, copper, rare earths, stuff needed for the energy transition. These areas tend to have maybe slightly shorter project cycles too.
Right, trying to get some quicker wins. Now, we can't really talk about the strategy shift, the NuScale sale, the huge buyback,
Yeah.
without mentioning the activist investor who popped up recently. Starboard.
Yeah, that's crucial context, definitely. Starboard disclosed their stake back in October, and their public push was basically unlock value, deal with the non-core assets, get cash back to shareholders, focus on NuScale.
And then, boom, on this earnings call, management delivers.
Yeah.
Pretty much exactly that. Clear timeline for NuScale exit, massive buyback funded by it.
The timing is convenient, let's say. It certainly looks like strong alignment now between what the activist was asking for and what management is delivering very quickly.
So did Starboard force their hand, or was this the plan all along and Starboard just showed up at the right moment?
Hard to say for sure from the outside, right? Management would say it's their strategy unfolding, but the acceleration certainly feels potentially influenced by that activist pressure. Either way, for shareholders, the outcome is faster clarity and a big commitment to return capital.
Which brings us nicely to our This Is Not Financial Advice segment. We take the data, the context, and try to sketch out a trade idea. Maybe a bit wild, but plausible based on everything we've just heard.
Okay, so given the cleanup, the de-risking, the buyback commitment, and the NuScale exit plan, how about this? We call it the de-risked buyback acceleration play.
De-risk buyback acceleration. Okay, I like it. How does it work?
It's kind of a two-parter. The core idea is you want to bet on management executing this turnaround in the main E&C business, right? But you also want to neutralize the noise or perceived risk from that NuScale stake they're selling off.
Okay, so part one is the bet on the core business.
Exactly. You go long Fluor's common stock. Yeah. You're betting that the improved execution continues, the reimbursable backlog delivers stable results, and crucially, that huge $800 million near-term buyback puts a real floor under the stock price.
Makes sense. Betting on management and the buyback support. What's part two? The de-risking part.
Part two is how you potentially finance that long stock position, or at least hedge the NuScale element. You'd look at shorting volatility on NuScale itself.
Shorting volatility.
Specifically, you could sell deep, out-of-the-money put options on NuScale stock. There are about 111 million shares Fluor still needs to sell by Q2 2026. By selling puts, you're essentially betting that NuScale's price won't completely collapse below a certain level before Fluor manages to sell its stake.
Ah, I see. So you collect premium from selling those puts, which helps offset the cost of buying the Fluor stock. And you're betting the NuScale sale happens smoothly enough.
Precisely. You capture the upside from Fluor's core E&C recovery and the massive capital return, while effectively neutralizing the market's worry about the NuScale overhang. You're isolating the bet on Fluor's execution.
And the rationale is that the Santos cleanup is truly done, the activist pressure keeps them disciplined on capital allocation, and that NuScale cash will flow into buybacks as promised.
That's the bet. It assumes management delivers on this clear plan they've laid out. It's de-risked because the riskiest part, the NuScale investment, has a clear exit path now.
Okay, that's definitely a wild but plausible one, playing multiple angles from the call. So let's recap the whole deep dive then. Fluor's Q3. Definitely a masterclass in accounting triage, as you called it.
Yeah, they managed to wall off that big, ugly Santos litigation charge from the underlying story.
And that underlying story was actually pretty good, right? An operational beat on adjusted EPS, raised guidance for the full year.
And a huge commitment to return capital. That $800 million accelerated buyback, funded by the clear plan to exit NuScale by mid-2026. Plus, the shift to a much lower risk, reimbursable backlog.
The narrative now seems squarely focused on execution and shareholder returns.
It is, which leaves maybe one final thought for you, the listener, to ponder. We saw management move very fast on the NuScale exit and the buyback right after Starboard showed up. So how much of this sharp, positive strategic shift was genuinely driven by the CEO's internal plan for disciplined delivery? And how much was maybe nudged along or accelerated by that activist spotlight? And maybe more importantly, does that $800 million buyback target backed by real cash flow and asset sale proceeds represent a genuine floor for Fluor's valuation in the near term? Something to think about.
Definitely something to think about. Great insights today. Thanks for joining us on this deep dive.